In 1873, railroad debt collapsed and triggered 23% unemployment. The Depression lasted 6 years. In 1929, total debt hit 260% of GDP. The stock market fell 89% over 3 years, 25% unemployment. It took 25 years to recover. In 2008, credit market debt reached 350% of GDP. Stocks crashed 57%. Banks needed $16 trillion in bailouts. 5 years to recover, but 2025 is different. This time, government debt, corporate debt, and consumer debt are all exploding simultaneously in what economists call the final debt cycle. And when all three detonate together, there's no central bank powerful enough to stop it. What if I told you this isn't speculation? We're in 1928, right before the Great Depression. Except this time it's worse because the tools that saved us in 1929 and 2008 no longer exist. The Federal Reserve can't cut rates to zero because inflation is still elevated. They can't print unlimited money because they just did that and caused 9% inflation. The government can't bail everyone out because it's already drowning in $36 trillion of debt. The three simultaneous debt bombs. To understand why 2025 is different from every previous crisis, you need to understand we're not facing one debt bomb. We're facing three simultaneous explosions that have never occurred together in financial history. Start with sovereign debt. The U.S. federal government owes $36.2 trillion. That's 123% of GDP, the same ratio America had at the end of World War II. Except after the war, America was the only major economy left standing. Today, we're competing with countries that have lower debt and stronger fundamentals. The annual interest payment on this debt now exceeds $1.1 trillion per year, making it larger than defense spending, larger than Medicare. When your interest payments alone exceed everything else, you have three choices. Cut spending drastically and cause a recession. Raise taxes drastically and cause a recession, or print money to pay the debt and cause inflation. All three options lead to economic crisis, but here's where it gets worse. $9.2 trillion in treasury bonds mature in 2025 and 2026. They must be refinanced. These bonds were issued at 1 to 2% interest. Today's rates are 4 to 5%. Every 1% rise in interest rates adds $360 billion to annual interest costs. This is the doom loop. Higher rates mean higher interest payments, which require more borrowing, which requires issuing more bonds, which drives rates even higher. Countries caught in this loop either default or destroy their currency through inflation. There's no third option. The second bomb is corporate debt. Total U.S. corporate debt stands at $13.7 trillion. 20% of publicly traded companies are zombies. They cannot cover their interest payments from operating profits. They only survive by borrowing more money. In 2025 and 2026, $1.4 trillion in corporate bonds must be refinanced. These companies borrowed at 2 to 3% during the pandemic. Now they must refinance at 6 to 8% while revenues are declining. The math doesn't work. They will default. Commercial real estate illustrates the crisis perfectly. $2.9 trillion in commercial mortgages exist. $1.5 trillion mature in the next 18 months. Office buildings sit 45% vacant as remote work becomes permanent. San Francisco has a 35% vacancy rate. These buildings were financed at 3% interest. The mortgages now come due and must be refinanced at 7 to 9%. The buildings aren't worth enough to support the new debt service. Defaults are mathematically certain. The third bomb is consumer debt. Total household debt exceeds $17.9 trillion. Credit card debt hit $1.14 trillion with average interest rates of 21%. Auto loans total $1.63 trillion with average terms now 68 months. Student loans equal $1.77 trillion across 43 million borrowers. Credit card delinquencies have reached 10.7%, higher than the 2008 financial crisis peak of 9.6%. Auto loan delinquencies hit 8.2%, 60% higher than the financial crisis. Personal savings rates have collapsed to 3.9% versus an 8.3% historical average. 78% of Americans now live paycheck to paycheck. This is the everything debt bubble. Government debt at World War II levels. Corporate zombies that cannot survive higher rates, and consumers already breaking under record debt loads. When all three explode together, the cascade is unstoppable. Why the tools are exhausted. In 2008, the Federal Reserve had powerful weapons to fight the crisis. Interest rates stood at 5.25%, giving them room to cut all the way to zero. They implemented quantitative easing, buying $4.5 trillion in bonds to inject money into the financial system. The government borrowed to bail out banks because federal debt was only 67% of GDP. These tools worked. The economy recovered in 5 years. But in 2025, every single tool has been exhausted. Start with interest rate cuts. The current Fed funds rate sits at 4.5%. That seems like room to cut until you realize inflation is still 3.4%, well above the 2% target. If the Fed cuts rates aggressively, they risk reigniting the inflation spiral that just required painful rate hikes to control. They're trapped. Cut rates and get inflation. Don't cut and let the economy crash into depression. There's no good option. The 1970s proved what happens when central banks try to cut rates during inflation. The Fed cut rates in 1975 trying to help the economy. Inflation surged to 14.8% by 1980. It took 2 recessions and 20% interest rates to kill it. The Fed cannot make that mistake again. But here's the real problem. With $36 trillion in government debt, every 1% rate cut saves $360 billion in interest costs, but adds up to 0.8% to the inflation rate according to the Fed's own models. The inflation costs far exceed the interest savings. Rate cuts don't work anymore. Next, quantitative easing. The Fed's balance sheet peaked at $8.9 trillion after COVID. It currently stands at $7.4 trillion. Before 2008, it was $870 billion. The Fed already owns 20% of all Treasury bonds. Everyone now understands that quantitative easing equals inflation. The 2021 to 2023 experience proved it beyond doubt. The Fed printed $5 trillion. Inflation hit 9.1% in June 2022, the highest in 40 years. Savings were destroyed. Wages couldn't keep up. The public watched their purchasing power collapse in real time. If the Fed tries massive QE again, the dollar will collapse. China has already reduced Treasury holdings from $1.3 trillion in 2013 to $770 billion today. Japan, the largest foreign holder, is reducing purchases to deal with its own debt crisis. If the Fed becomes the only buyer of U.S. debt, it signals currency collapse. International investors will flee. The dollar could lose its reserve currency status. That would be catastrophic. Import prices would explode. America's ability to run deficits would end overnight. Finally, government bailouts. In 2008, federal debt was 67% of GDP. The government authorized $700 billion for TARP. Total crisis spending reached about $2 trillion. Debt rose to 82% of GDP, high but manageable. In 2025, federal debt is already 123% of GDP. Annual deficits run $1.7 trillion. The government is paying $1.1 trillion just in interest. That's more than the entire 2008 bailout, paid every single year, just to service existing debt. A 2025 banking crisis would require $3 to $5 trillion in bailouts because the financial system is 10 times larger than 2008. That would push debt to 145 or even 155% of GDP. History shows what happens at 150% debt to GDP. Bond markets revolt. Greece in 2010, Italy in 2011. Interest rates spike. The government loses the ability to borrow. The debt spiral becomes unstoppable. The tools that saved the system in 2008 don't exist in 2025. They've been used, abused, and exhausted, and everyone knows it. The 12 indicators flashing red. Let me show you the 12 indicators that have never been wrong. Indicators that predicted every major crash with 0 false positives. All 12 are flashing red right now. Indicator 1, the inverted yield curve. When short-term interest rates exceed long-term rates, recession follows. This signal has predicted every recession since 1950 with no false positives, 0. The yield curve inverted in July 2022 and stayed inverted for 27 months, the longest inversion in history. It normalized in September 2024. Here's what most people don't understand. Recessions don't start during the inversion. They start 3 to 12 months after the curve returns to normal. The average is 8 months. September 2024 plus 8 months equals May 2025. The signal that has never been wrong is telling us the recession begins right now. Indicator 2, the Buffett indicator. Warren Buffett's preferred valuation metric divides total stock market value by GDP. Buffett himself said anything above 120% signals dangerous overvaluation. The indicator currently stands at 185%. In the year 2000, it hit 148% right before the dot-com crash destroyed 78% of the Nasdaq. In 2008, it reached 110% before stocks fell 57%. We're now at 185%, far beyond both previous crash levels. And what is Warren Buffett doing? Berkshire Hathaway is hoarding $325 billion in cash, the highest in company history both in absolute terms and as a percentage of assets. Buffett has been selling stocks for 8 consecutive quarters. He reduced his Apple position by 67% through 2024. The world's greatest investor is sitting in cash waiting for the crash because he knows it's coming. Indicator 3. Credit card delinquencies. The percentage of borrowers 90 days or more behind on payments has reached 10.7%. The 2008 financial crisis peak was 9.6%. We've already exceeded the Great Recession. Indicator 4. Auto loan delinquencies. 90 days past, due rates hit 8.2%. The 2010 crisis peak was 5.3%. We're 60% higher than the financial crisis. These aren't people being irresponsible. These are people who can't make ends meet. Average monthly car payments exceed $740. Loan terms have stretched to 84 months, 7 full years of payments. This is subprime lending disguised with different terminology. Indicator 5. The Sahm Rule. Economist Claudia Sahm discovered that when the 3-month average unemployment rate rises half a percentage point above its 12-month low, the economy is already in recession. This rule has predicted every recession since 1970. 0 false positives. The 12-month low was 3.4% in April 2023. Current unemployment stands at 4.2%. That's a rise of 0.8%. The Sahm Rule is triggered. We're already in the early stages of recession. Indicator 6. Commercial real estate vacancy rates. Nationally, office buildings sit 19.6% vacant. San Francisco is at 29.4%. New York City, 22.1%. $1.5 trillion in commercial mortgages must be refinanced in 2025 and 2026. These properties were financed at 2.5 to 3.5% interest. Current refinancing rates are 7 to 9%. Property values have dropped 40 to 60%. The math is simple. These loans cannot be refinanced. Defaults are certain. Indicator 7. Residential housing overvaluation. The price-to-income ratio stands at 5.8 times versus a 4.1 historical average. The price-to-rent ratio is 41% above historical trend. At the 2008 peak, housing was 35% above trend. We are now 41% above trend. This housing bubble is 17% larger than the bubble that caused the Great Recession. Indicator 8. Regional bank unrealized losses. Banks are sitting on $558 billion in unrealized losses on their balance sheets, according to the FDIC. These are losses that exist but haven't been recognized yet because banks haven't sold the securities. When deposit withdrawals force banks to sell these securities, the losses become real. Capital ratios collapse. Banks fail. The FDIC insurance fund holds $125 billion but insures $10.5 trillion in deposits. When the next wave of bank failures hits, the fund will be depleted in weeks. Indicator 9. Insider selling. Jeff Bezos sold $13.5 billion in Amazon stock through 2024. Mark Zuckerberg sold $10.2 billion in Meta. Jamie Dimon sold JP Morgan stock for the first time in 18 years. Corporate executives see the real numbers before anyone else. When they're selling billions at record pace, they're telling you valuations are insane. Indicator 10. The Magnificent Seven concentration. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla represent 30% of the entire S&P 500. Nvidia alone accounts for 7% of the index with a price-to-earnings ratio above 65. When these 7 stocks crash, they take the entire market down. This concentration hasn't existed since 1929. Indicator 11. China's debt crisis. Total Chinese debt, including local government hidden debt, reaches 287% of GDP. The real estate sector, 30% of the economy, is in freefall. 50 developers are in default. Youth unemployment hit 21% before China stopped publishing the data. When China crashes, global trade collapses. Indicator 12. Japan's debt trap. Debt to GDP stands at 264%, the highest in the developed world. The Bank of Japan owns 53% of all government bonds. They cannot raise interest rates without bankrupting their own government. The yen has fallen 30%, but raising rates would cause a debt crisis. They're trapped. These aren't predictions. These are facts happening right now. 12 indicators, 0 false positives in their history, all flashing red simultaneously. The cascade scenario. The crash won't announce itself with a clear starting point. It will begin with something that seems manageable. A major tech company missing earnings. A large regional bank announcing losses on commercial real estate. A treasury auction that fails to find enough buyers. The trigger itself almost doesn't matter because the system is so fragile that any shock starts the cascade. Here's exactly how it unfolds. When Nvidia or Microsoft or Apple misses earnings projections, algorithmic trading systems start selling instantly. The stock drops 10 to 15% in a single day because these companies represent 30% of the S&P 500. That alone takes the index down 6 to 9%. But the real damage comes from margin calls. When investors buy stocks with borrowed money and those stocks decline, brokers demand additional cash. If investors can't provide it, brokers sell the stocks automatically. This forced selling drives prices lower, which triggers more margin calls, which forces more selling. In 1929, margin calls created a downward spiral that couldn't be stopped. In 2025, margin debt as a percentage of market value equals 1929 levels. The selling will be rapid and relentless. Within the first month, stocks could easily fall 30 to 40% as retail panic, margin calls, and institutional risk management all drive prices lower simultaneously. Institutional investors managing trillions in pension funds have automated risk systems. When stocks fall 20%, these systems trigger automatic selling to prevent further losses. This isn't emotion, it's programmed. The cascade moves from stocks to bonds as investors flee to what they believe is safety. But treasury bonds aren't safe in 2025. The government needs to issue trillions more to cover deficits and refinance maturing debt. When there's a flight to safety at the same time, the government needs to sell bonds. Interest rates spike higher. This creates the doom loop. Higher interest rates make the government's debt service costs higher, which requires more borrowing, which requires issuing more bonds, which drives rates higher. Countries caught in this loop end in default or currency collapse. The housing market freezes completely. Buyers disappear overnight. Sellers refuse to accept lower prices. Homes sit on the market for months without offers. People who need to sell for job relocations or financial desperation start cutting prices. These price cuts establish new comparables that drive all home values lower. Within 6 months, home prices drop 20 to 30%. Within a year, 40 to 50% declines are realistic in overvalued markets like Austin, Phoenix, and Boise. Homeowners who bought in the last 3 years find themselves underwater, owing more than their homes are worth. Commercial real estate defaults accelerate exponentially. Property owners realize they cannot refinance maturing mortgages. They stop making payments and mail the keys to the lender. The lender, typically a regional bank, takes possession of a property worth 40 to 60% less than the loan amount. This wipes out the bank's capital. When capital ratios fall below regulatory minimums, regulators close the bank Friday evening. The news spreads over the weekend. Monday morning, depositors rush to withdraw money from any bank that looks similar. This creates classic bank runs. Even healthy banks don't have enough cash to pay all depositors simultaneously because they've lent the money out. When runs start, banks must sell assets at fire sale prices to raise cash. Selling assets at a loss can turn a healthy bank insolvent overnight. The FDIC steps in, but the $125 billion insurance fund is laughably inadequate. The government has to print money to cover deposits. This starts the inflation that destroys the currency. Employment collapses as companies cut costs through mass layoffs. Tech companies that grew bloated during the boom lay off 10 to 20% of workforces. Financial companies heavily exposed to market declines eliminate entire divisions. Retail companies facing customers who stopped spending close stores by the thousands. Within 3 months of the crash starting, unemployment rises from 4% to 7 or 8%. Within 6 months, 10% is realistic. Within a year, 12 to 15% unemployment is likely as cascading failures move through every sector of the economy. The Federal Reserve faces an impossible choice: print trillions and destroy the dollar through inflation, or let the crash play out and accept depression-level unemployment for a decade. There is no middle path. The tools that worked in 2008 don't work in 2025. They've been overused. They've been exhausted, and everyone understands the consequences. This isn't theory. This is mathematics. When debt reaches levels that cannot be serviced, when asset prices exceed any rational valuation, when all policy tools have been exhausted, the cascade is inevitable. The only variable is timing. The human cost and timeline. Let me show you what this means for real people. For the average American with a 401k or IRA, watching their retirement account decline 60 to 70% will be devastating in ways that go beyond just numbers. Someone who spent 30 years saving, who has $600,000 in their retirement account, watches it drop to $200,000 or less. That's not a correction. That's the destruction of their financial future. They cannot retire. They have to work 10 to 15 more years, assuming they can keep their job through the recession. For people already retired and depending on portfolio withdrawals to fund living expenses, the situation is catastrophic. They're forced to sell assets at the bottom to pay bills, locking in losses they will never recover. In 2008, retirement accounts dropped but recovered within 5 years. Most people who held on got back to even. In the coming crash, recovery will take decades if it comes at all. Japan's stock market crashed in 1990 and didn't recover to those highs until 2024. 34 years. An entire generation of Japanese investors never recovered their wealth. The same will happen in America. 30 million retirees and near retirees will see their life savings destroyed. College graduates in 2026 and 2027 will enter the worst job market in a century. No entry-level positions exist. Companies aren't hiring. The jobs that do exist will have hundreds of applicants. This generation will start careers 5 to 10 years behind where they should be, suppressing their lifetime earnings permanently. Studies of people who graduated into the 2008 recession showed they earned less over their entire careers. The 2025 crash will be worse. The economic scarring will be deeper and last longer. 15 million young people will have their economic futures destroyed before their careers even begin. Small businesses will be decimated. The local restaurant, the retail shop, the family service business. These will fail by the hundreds of thousands. Consumer spending collapses. Credit becomes unavailable. Revenue disappears overnight, but rent and payroll continue. Within 6 months, 8 to 12 million small business owners will lose everything they built. Their life savings, their homes, their futures. Large corporations with access to capital markets will survive, though smaller. The economy that emerges will be even more dominated by massive corporations. Competition dies, innovation dies, economic dynamism dies. Here's the precise timeline. Q1, 2025, January through March. The trigger event occurs. Markets crash 20 to 30%. Credit markets freeze. First wave of bank failures begins. Q2, 2025, April through June. Unemployment rises to 7 to 8%. Housing prices start falling rapidly. Commercial real estate defaults cascade. The FDIC fund is depleted. Government emergency measures begin, but they're insufficient. Q3, 2025, July through September. Unemployment hits 10 to 12%. Major bankruptcies accelerate. Retailers, tech zombies, regional banks. Political crisis intensifies. International contagion spreads to Europe and Asia. Q4, 2025, October through December. Unemployment reaches 13 to 15%. Housing down 30 to 40% from peak. Social safety nets begin failing. States run out of unemployment funds. Political extremism surges as people look for someone to blame. Throughout 2026, the bottoming process begins, but recovery doesn't. Unemployment peaks at 15 to 18%. The stock market sits 65 to 75% below its peak. Housing has fallen 40 to 55%. And here's the critical difference from 2008. Recovery will take 8 to 15 years minimum. Why? Because the Fed cannot cut rates to zero. Inflation is still elevated. They cannot print unlimited money. The dollar's reserve status is at risk. The government cannot bail everyone out. Debt is already at 123% of GDP. No international rescue is coming. China and Europe face their own crises. Japan's 1990 crash took 34 years to recover. America's 1929 crash took 25 years. The 2025 scenario combines the worst elements of both. Stock market recovery to 2024 levels won't occur until 2038 to 2042. An entire generation will live through economic stagnation. Political instability follows economic collapse. The 1930s saw the rise of extremist movements across Europe as desperation made people vulnerable to authoritarian promises. Weimar Germany's crisis helped bring Hitler to power. America isn't immune to political consequences of catastrophe. When people lose everything, they demand radical solutions. The 2025 crash will reshape American politics in ways we cannot predict, but will certainly be destabilizing. This is the human cost, not just numbers on a screen. Real lives destroyed, real futures stolen, real suffering that will span decades. The final warning. So why is 2025 worse than 1929 and 2008 combined? Because we have the asset bubbles of 1929, the debt bubbles of 2008, and the government debt crisis that didn't exist in either. All three exploding simultaneously. In 1929, only 10% of Americans owned stocks. 90% weren't directly affected by the crash. In 2025, 58% own stocks through retirement accounts. When markets crash, everyone's savings disappear immediately. In 2008, the government could borrow to bail out banks. Debt was 67% of GDP. The Fed could print money without causing inflation. China was booming and pulled the world toward recovery. In 2025, debt is 123% of GDP. The Fed just caused 9% inflation by printing money. China faces its own crisis with real estate collapsing. No rescue is coming. The warning signs aren't speculation. They're fact. The yield curve normalized September 2024. Recession follows within 12 months. The Sahm Rule triggered November 2024. It has never been wrong. Banks hold $558 billion in unrealized losses. $1.5 trillion in commercial mortgages cannot be refinanced. Consumer delinquencies exceed 2008 levels. Buffett hoards $325 billion in cash. Insiders sell at record pace. Housing is more overvalued than 2008. Every indicator flashes red. This is pattern recognition. The same patterns before 1929 and 2008 exist now, except worse. Stocks will fall 65 to 80%. Bonds 35 to 50%. Real estate 40 to 60%. Unemployment will exceed 15%. Recovery takes 15 to 20 years because the Fed has no tools and government has no capacity. The everything bubble crashes together. Nowhere to hide. The Fed cannot cut rates. Inflation remains at 3.4%. They cannot print money. It destroys the dollar. Government cannot bail out. Interest payments alone equal $1.1 trillion annually. The tools are gone. The indicators triggered. The timeline is clear. First quarter 2025 through third quarter 2026. The crash isn't coming. We're inside it. The cascade has begun. This is the final debt cycle. The last time debt reaches these levels before mathematics force a system reset. The crash is locked in. The only question is whether you see it coming.